Hello everyone, my name is Max Monk. I'm a portfolio manager here at Johnson Investment Counsel, and this is the JIC Research Edge. Today I'm joined by Ryan Martin. Ryan is a fixed income portfolio manager within our asset management division. Ryan, thanks for joining me today.
Thanks.
One of the most common concerns we've been hearing from clients is about inflation. These concerns are understandable as inflation has the potential to really erode the purchasing power of one's savings over time. In today's discussion, Ryan and I are going to cover some of the basics of inflation, what has been driving inflation here recently, as well as what JIC is doing in client portfolios to offset the impacts of inflation. So Ryan, starting out at kind of the most basic level, can you just explain what inflation is and maybe how it impacts our clients?
Sure. So simply put, inflation is just the general rising of prices in an economy. An easy example to think of is the cost of a cup of coffee or a gallon of milk, which has risen over the years. From a tracking perspective, we tend to look at indices that are attempting to track price changes in a wide variety of goods and services. The two most commonly known indices are probably CPI, the Consumer Price Index, and PCE, the Personal Consumption Expenditures Index. These two indices are essentially trying to do the same thing, which is capture price changes in a wide variety of goods and services, with the main difference being that CPI is attempting to track price changes for urban consumers, and PCE is attempting to track price changes for all consumers in the U.S. economy. Commonly known variations are core CPI and core PCE, with the main difference here being that food and energy prices are excluded from the calculation. Food and energy prices tend to be very volatile at times, so removing them and looking at a core calculation of inflation is a preferred method of many economists. So the most direct and obvious way that inflation impacts the consumer is via the increase in prices that we're talking about. It's very easy to feel the impact of inflation when you're buying goods and services at a higher price today than you had in the past. One of the less direct and less obvious ways that inflation is impacting a consumer, though, is the impact that it has on their savings. So in an inflationary environment, as prices are rising, the value of your savings is actually decreasing as it's now going to be worth less in terms of what you can buy with your savings in the future.
So certainly something that investors ought to be paying attention to. Could you talk about what some of the primary drivers for inflation are, and maybe more specifically, what has been driving some of the more recent concerns among investors about higher potential inflation?
Demand outpacing supply has historically been the main driver of inflation in the United States. The potential for that dynamic, along with an increasing money supply, are two of the main factors that have people talking and thinking about inflation right now. I do think it's important when you're thinking about inflation to separate short-term cyclical trends and longer-term secular outlooks. It is certainly possible that we'll see an uptick in inflation numbers in 2021, coming off a year in 2020 where we actually had periods of deflation. We're currently in an unprecedented time period right now with the economic bounce back from COVID happening much quicker than I think most people expected. There's a lot of pent-up demand out there, and there's also been massive amounts of fiscal stimulus aimed at supporting consumers in the economy. I think it's safe to assume that it's likely that we'll see an increase in consumer spending in 2021 relative to what we saw in 2020, but that should be a temporary increase. So easy monetary policy and increasing money supply is the other factor that I mentioned. While the money supply has increased significantly over the last year, the velocity of money, which is the amount of times that a single dollar changes hands year over year, has declined to almost the same degree. Debt levels are already high, banks are much more conservative than they were many years past, and that really helps keep a cap on any potential inflation that we might see as a direct result of an increasing money supply. So all the factors that have kept longer-term inflation suppressed over the last few decades, such as an aging population, high levels of public and private debt, and low overall economic productivity remain in place. Those are the factors that are going to drive inflation on a longer-term basis more than what is likely a temporary spike in demand and liquidity that we'll see in 2021 as things increasingly return to normal.
So whether we see higher inflation or not, I imagine that there are ways that investors can mitigate against this risk. Can you tell us what Johnson is doing in client portfolios to help offset some of the impacts against inflation?
Sure. So one way to combat inflation is to maintain a well-diversified portfolio, and ideally one that continues to maintain some equity weight and real asset weight into retirement. Historically, stock returns have outpaced inflation, and stocks have provided positive real returns against inflation over time. Additionally, holding an actively managed bond fund can also help mitigate the impact of inflation. So interest rates are likely to rise in an inflationary environment, but in an actively managed fund, your cash flow is being reinvested at those higher rates. And over time, high quality bonds have also provided positive real returns against inflation. Cash is the asset class that historically does very poorly against inflation. So while it certainly can make sense to maintain a cash allocation at times, staying fully invested is really one of the best ways to mitigate the impact of inflation on your portfolio. So as always though, this should be taken into consideration with your own individual situation and goals, and any questions can be addressed to your portfolio manager.
Absolutely. Well, thank you for your time today, Ryan, and thanks to all of you for watching at home. If you'd like to read more about our inflation expectations, we'll have an article in our quarterly insight newsletter that's coming out next week. You can find our other newsletters, blog posts, and other Research Edge videos on our website at www.johnsoninv.com. Thank you and have a great day.